You've seen the boxes. Every smart money trader on YouTube draws them. Every Discord mentor charges you $200 a month to teach you where to draw them. And half of the indicators on TradingView are just glorified box drawing tools for one pattern. It's called the fair value gap, or FVG for short. Most people using this term couldn't tell you where it's even coming from, what it's actually measuring, or where it genuinely helps you versus where it's a pretty box. Today, I am fixing all three. Where this concept is coming from, what is actually under the hood, and one context where it's genuinely worth your attention. Let's get into it. Before we talk history, you need the actual definition, because most explanations online overcomplicate this. A fair value gap is a 3-candle pattern. It forms when the price moves so fast in one direction that it skips over a chunk of the price. Nobody traded there. No orders got filled there. There's a literal gap in the auction process. Here's the mechanics. A bullish fair value gap, look at the 3 consecutive candles. If the high of candle 1 overlaps the low of candle 3, that gap, that untouched zone between them is a fair value gap. A bearish fair value gap, it's the same idea but flipped. The low of candle 1 doesn't overlap the high of candle 3. The theory is that the price is inefficient in that zone. Trading didn't happen there in a two-sided way. So the market has a tendency to come back and rebalancing it before going in its original direction. That is the whole premise. Price extends aggressively, leaves a gap, then often returns to fill part or all of that gap before resuming. That's the pattern. Everything else you've heard is decoration on top of this. Here's where most videos actually get lazy. They'll say smart money concept and just move on. Let's actually trace it. The fair value gap as a name, popularized concept, comes from Michael Huddleston, better known as his alias ICT, which stands for Inner Circle Trader. Huddleston is originally from St. John, Michigan, and by his own account, he did not come from a finance background. He got into commodities and future trading after encouragement from a family member. And it took him years of losses to even become consistently profitable. What matters for our purpose in this, starting in early 2010s, Huddleston began teaching publicly, first on forums like Baby Pips, and later through his own YouTube channel. His entire framework was built over one core argument. The price doesn't move randomly, purely based off supply and demand, the way retail traders have been taught all this time. Instead, he argues institutional players like banks and hedge funds algorithmically engineer price movement to run stop losses and collect liquidity before making the real move. So out of that framework came a full toolkit. Order blocks, liquidity pools, market structure shift, the power of 3, and the one we all care about today, the fair value gap. Now here's a nuance that is worth mentioning because it is important for you as a trader to understand. The concept of price gaps and imbalance isn't actually new in trading. Traditional technical analysis has spoken about imbalance and price inefficiency in the market for decades now. What Huddleston did, this was the actual innovation, was to package it, name it, and to teach it as a coherent institutional order flow story. Distribute it for free on YouTube to a mass audience. That combination is why the fair value gap is now a term that nearly all retail traders have heard of or know about, when 10 years ago no one used that specific phrase. Around 2022, ICT's following exploded. That's really when the fair value gap went from a niche forum concept to half of fin tweets and trading channels now draw these boxes. The broader label for the style of trading is smart money concept, or SMC. It's a largely community-driven simplification of Huddleston's original, much more dense framework. So when someone tells you fair value gaps is the secret of institutional playbook, what they really mean is one trader packed an old idea into a very teachable, very visual pattern, taught it for free at scale, and it went viral. That doesn't make it useless, but it doesn't make it magic either. It makes it a pattern. Patterns need to be tested. That's what we do on this channel. Let's now move from history to application. There are 3 things you need to nail with fair value gap: identification, context, and entry. You already know the 3 candle rule. Here's what separates a useless fair value gap from one worth watching: displacement. A candle formed by a small, boring candle isn't the same as a large, aggressive, high momentum kind of candle. You want the middle of the candle to show real conviction. A strong body, ideally breaking prior structure levels. A tiny gap during a choppy day isn't the same signal as a gap that forms during a violent breakout. This is where most traders fail. A fair value gap by itself isn't an actual trading signal. signal. It's a zone of interest. The question you always have to ask is, what is price doing when it gets back to that zone? The highest probability of a fair value gap is a pullback entry in the direction of the higher time frame, not as a standalone reversal signal. If the daily trend is up and the price rallies hard, leaves a fair value gap, leaves a bullish fair value gap, and then price pulls back into that fair value gap, that is completely a different trade than trying to fade a random fair value gap against the trend with no other confirmation. This is exactly why on this channel we always stack a higher time frame filter, something like a 15-minute or higher EMA on top of any entry pattern. Fair value gap tells you where institutions may be interested in going in. The higher time frame tells you what direction you should actually be looking for. Here are the actual entry mechanics. Most of ICT style traders enter in one of two ways. Touch entry, you enter the second the price touches the actual fair value gap, or confirmation entry. You wait for price to show some kind of reaction inside the actual gap, like a rejection wick or a shift to short-term structure before entering. Touch entries get you better filled prices, but can give you more false entries. Confirmation costs you some entries, but it does give you better trades and it filters out the market noise a little better. Neither objective is actually wrong though. It's a trade-off between price and probability, and it's exactly the kind of parameter that should be a toggle between the two types on any indicator you are using, and it should not be hard-coded. You should be able to have the flexibility to turn it off and on. If I were to boil down where fair value gaps actually give value versus where they're just random noise, it's this. A fair value gap works best as a targeted entry refinement tool inside of a trend following system, not as a standalone strategy. The best use case looks like this. Establish a higher time frame bias, a trend direction using structure or a higher time frame EMA or moving average. Wait for a displacement in that direction, a strong impulse candle that leaves a fair value gap behind. Wait for the price to pull back into the fair value gap. Enter with one of the two styles, either touching or getting a confirmation when the price is actually within the fair value gap itself. This gives you what most retail traders are missing: a precise, a low risk entry point inside of a larger, already favorable directional buy. Fair value gaps aren't predicting the market. It gives you a tighter stop and a better risk to reward ratio for a trade you were going to take anyway. Where fair value gaps get abused is when people use them in isolation, trying to call out a reversal on a 1-minute chart with no higher time frame bias or contact. That's where the pattern falls apart, and it's exactly why so many people say ICT stuff does not work. They are using a refinement tool as if it was a complete strategy, but it is not. Fair value gaps aren't some secret institutional code that's always existed in the shadow. They're a well-packaged, a well-taught pattern popularized by Michael Huddleston, also known as ICT, in the early 2010s. And it didn't hit real mainstream retail trading until 2020. Good teaching and good marketing turned an old idea into a household term. That's worth knowing before you treat it like an ancient institutional secret, which it isn't. The definition is very simple. Resist the urge to overcomplicate the simple pattern. 3 candles, a gap between candle 1 and candle 3, and that's it. Everything else, displacement, time frame, entry style, is a refinement on top of the base definition. Context is everything. A fair value gap in isolation on a low time frame with no trend behind it is just a shape on the chart. A fair value gap that forms with real displacement in the direction of a higher time frame trend used as a pullback entry, that's the version of the concept that is worth your screen time. If this clears up what a fair value gap actually is and where it comes from, that's the point of this channel. Cutting through the SMC jargon and showing you what actually happens underneath it. Next week, I'm taking this concept and coding into an actual trading view indicator so you can see it marked automatically on your chart instead of you having to draw things manually. That will be Wednesday's video, followed by the Ninja Trader version on Friday. Subscribe if you want the plain English versions of these concepts before you ever pay for a course to learn them. See you on the next one.